Welcome to the lecture on interest and interest rate and time value of money. So, we will discuss in this lecture about the interest which is charged by the financial institutions, by the investors. This transaction of money whenever occurs, because the money has a value which is function of time. So, as you cannot say, so we will discuss the time value of money later, and because of this time value of money, the interest comes into picture. So, what happens that what is interest? So, if you look at the definition of interest, interest is the rental amount charged by financial institutions for the use of money. Now, the money which is used for satisfying the your wishes, it gives you happiness, you are able to purchase something. So, it is able to satisfy your wishes, you are getting satisfaction, and you are able to get those assets which has the utility for you. So, whenever you use that, if you have that much, you can purchase it, but if you have not, then you can lend it to someone, and they can have their wishes being completed, their needs can be fulfilled. So, but for that the person who is lending, he is charging a rental, and that amount which is charged basically is known as the interest. Now, economic gain from use of money is what gives money its time value. So, as you know that with time, so whatever economic gain you get from the money in time, so you have got that much advantage because of that money. So, that is why if you have money at that at now, its value will be more at a later time. So, so that way this value of money at a particular time. So, time value of money is coming important. Now, time value of money has to be considered for economic ventures. You have to consider it. Many a times we also compromise many a things. You have you have things of uncertainty also there many a times, and also you can see that you have inflation. Inflation is also there, which basically will be making it devalued. So, whatever money you have today, you cannot purchase the same thing after 1 year, because its value is decreasing. So, so that way the time has a role in it, and also the uncertainty. So, there are a few things which basically are into it. So, so if we will discuss on these things. Now, rate of gain received from an investment is called the interest rate or rate of capital growth. So, so at what rate you are basically having that the receiving. So, that percentage is basically defined, and that is known as the interest rate. Now, if you see that effect of time and interest rate must be given due consideration while dealing with monetary transactions. So, when you are dealing with the monetary transactions, you have to see that your time and the interest rate both must be given the due consideration, and in fact interest may be charged in different way over time by the lender to the borrower. So, if you look at the history of the use of interest, so in the earlier days the interest might be in the form of other units, it may be in the form of grains, it may be in the form of the land or so, but in today's world, since the transactions are mostly done in the monetary way. So, you have the things are basically things have developed. Earlier there were transactions in other way, now we are doing mostly the transactions in the term of money. Now so as we discussed that the rental rate for sum of money is usually expressed as certain percentage of the sum to be paid for its use for a period of 1 year, and that is how the rate when you define for a particular period, most conventionally we define for 1 year, and then that is why it is we define it as interest rate per year. So suppose you are lending someone 1 lakh rupees and you want to see that you get 10%. So 10% of the interest rate. So ultimately what will happen that at the end of the year its value will be 1,10,000. So 10,000 what you receive, that is the interest, and the 10% is known as the interest rate. So that is the rate at which you are getting the amount because of its use during that period. Now there are many ways by which these interests are computed, and you have simple interest and the compound interest. So as you know that when we talk about the calculation of interest or simple interest, so in that the calculation is that whatever is the present amount or the principal amount, and the interest earned will be for a particular time. So it will be for a based on the rate. So if the rate is specified on year basis, so for first year if the rate is suppose 5%, so 5% of any amount, that will be the interest for 1 year. So in the case of a simple interest, the interest rate will be there defined, and it will be always the percentage of the principal amount and for a particular period. So for 1 year, for suppose 1.5 year, you have to again multiply with 1.5. So that way in terms of that you calculate the simple interest. Now in the case of compound interest, what is supposed, now in this case the interest remains fixed. However, we also have the case and there has been cases, and this case is very in normal practice, that the interest rate which is accrued after a certain time, that becomes a part of the principal amount, and then in the next period your interest rate is charged on the principal amount plus interest rate accrued, interest amount accrued. So this way there is compounding done. So you are basically doing the interest of the interest amount also. So you are not every time doing the interest of the principal amount also. So basically what is happening that in the so if you have P as here, and so in the case of simple interest, so in the simple interest you will have P, and you have years going on, and interest amount will be calculated every year, I1, I2 and I3 and so. So this way your I1, I2, I3 will be going on. Certainly P is at its own place, whereas if you have a compound interest, now in this case basically the I1, I2 or I3, they are fixed, and it is fixed because it is a fixed percentage of this amount P if this time period is same. Whereas in the case of compound interest, what happens that in the first year the interest is I1 although, but in the second year it will be so here these all are same. So I1, I2, I3, they are all same. However, in this case I2 will be what you get, it will be based on P plus I1. So similarly the I3 which you get, it will be based on P plus I2, P plus I1 plus I2. So, what you see is that the interest which is computed in the case of compound interest, in that basically you are also calculating the interest of the interest which is there in the earlier time. So, that is why it is known as the compounding of the interest. So, you have two types of interest, simple interest and compound interest, and normally we will discuss in our coming lectures that there are many ways by which this compounding is done, and there are many kind of compounding frequencies of interests and all that. So, but we must know that this is the two type of interest which is normally available defined. Now, so as we discussed that when we talk about the simple interest, the interest owed upon repayment of loan is proportional to length of time the principal sum has been borrowed. So, the interest amount, interest rate earned, it will be P is the principal amount, N is the number of interest period, and I is interest rate. So, based on that we calculate the simple interest, and as you know that if the I is fixed, suppose you have I is interest rate for a particular interest rate, if N you are calculating for a particular period. So, whatever be the whenever you are calculating this for I and N means first year, second year or third year. So, since P is fixed, it will be the same, whereas in the case of compound interest, what we is done is that this interest amount which is generated every year, that will be varying. So, in the first year it will be P and I, second year it will be I into N into P plus I1. So, that way it will be going on. A simple interest loan may be made for any period of time. Interest and principal become due only at the end of the time period. So, when we talk about the simple interest, in that case you say that the interest and also the principal amount, they are due only at the end. So, your interest amount will also be summed up, and the principal amount then will be summed up, that is, and that is the last amount which is to be paid by the borrower. So, that is how this simple interest is defined. Now, when we talk about the compound interest, now in these cases the loan is made for several interest periods, and interest is calculated and payable at the end of each interest period. So, basically you are supposed to pay the interest at the end of each interest period, and if not, if you are paying the interest, it is fine. Otherwise you will have the interest calculation on the interest also, and this interest will be basically a part of your principal amount. So, it will be accumulated, and the interest owed in previous year becomes part of the total amount owed for this year. So, that way if you are paying the interest every year, then it is fine, but if not, then that becomes a part of your principal amount, and this interest amount is which is calculated for the year, it will be added to the principal amount. Now, effect of compound interest depends on payment amounts and when they are made. So, also when you are making, so mostly what happens that when the compounding of interest is done, then the time at which you are paying any amount, so that defines that what will be the next amount of interest which will be charged for you, because that will be the remaining amounts, on that the rate of interest will be charged. So, that way this compounding is being carried out. Now, what we see is that now we have discussed that this interest which is charged, it has many viewpoint. So, that is, it may be from the lender's viewpoint or it may be from the borrower's viewpoint. From the lender viewpoint, basically if you look at a person who has a lot of money. So, basically by looking at its money itself, he is quite happy. So, the happy which he is getting by looking at his money. Now, if he gives to someone, then certainly he is compromising with that happiness. So, for that he is going, he must be paid something. So, that is what he is earning, that is interest. So, that is why he is charging interest, but otherwise he can have it in his with him, and then he can boast of having or morally, or in socially also he may be quite comfortable that way. So, from the lender's viewpoint, there are many points by which you can justify the use of the use of interest being charged. Similarly, for borrower, because borrower has the inability to meet certain demands made by his family members, or he has to do some work, but he does not have the capital to do that, or he has to start a business to to sustain. So, in that case he has to get the money from someone, and his wishes are fulfilled, but for that he has to pay some extra amount, and that is what the interest is. So, this way you have the definition of interest for different purposes. Now, what we see is that there is cash flow over time, but before that we will talk about the time value of money. Now, what we see is that what we have seen, that when we talk about the interest. So, now suppose you are at 0 time and you have amount of P. Now, if you go to first year, you go to second year or so, if you go to the third year, fourth year or so, now this value P it will not be the same as it is now at any point of time. So, that is why the money, because here you will have its value as P plus interest. So, this is the the value addition to this amount P now, and that is how its value is basically changing, and that is why as you see that its value is changing with time, and that is why it is known as the time value of money. So, that is why we call it as the time value of money. Now, for knowing this time value of money, you must know the interest and the interest rate. So, basically the time and the interest rate. So, you have the effect of time and interest rate. Now, what will be the value of the money at a particular time? So, that time you must know, and at what rate you are trying to earn for on a certain amount. So, that basically is the interest rate. So, once you know the interest rate and you know the time, then in that case you can predict about its value at a particular time. Now, what we try to say that when we do the financial transactions, when we talk about the economic transactions, then what we say, suppose you are taking the example that you are taking a loan at now, and you will be paying it, paying back this loan amount in the coming years. So, if you are taking a loan of 1 lakh, certainly if you are returning the 1 lakh now itself, that is fine, but if you are keeping this amount, then this value of 1 lakh is going to be increased slowly. So, and you will not be, and most in most of the cases when you take a loan, since you are you cannot manage that much large amount at once. So, you have to borrow it from certain financial institution. Now, that institution, and since being a larger amount, you will try to repay it at different times. So, you will try to repay that at different times. So, you will have P now, and you will be paying maybe you have many installments. So, suppose you want to pay in many installments. So, the time period at which 1, 2, 3, 4, and this is suppose going to n minus 1 and this is going to n. Now, when we talk about the time value of money, at that time we know that you have two things, rate of interest and the time. Now, there may be the return of the money at this point of certain amount or at this point of certain amount. Now, these are the transactions, monetary transactions, or we also call it as the cash flow or transaction. Now, what happens that as we see that when we find, so at this point, suppose there may be a case that you have so for any, when we deal with the financial transactions of any organization or so. Now, at any point if you have something as income and something also has as the you have to pay. So, when you are going in the positive side, that is known as receipt, and if you are going to negative side, then it is known as disbursement. So, basically it is nothing but income and this is expenditure. So, what we see is that in such cases at this point, if you are doing the transaction at a particular time, then you can add them. However, if suppose you are doing certain transaction here and you want to analyze with some transaction, suppose this is x, this is y and this is z. Now, at this particular point at 2, you can have, since the time is same, the rate of interest is anyway fixed, that may also change. So, once that will change, that also is to be accounted into. Now, the rate of interest being same and time being same, if both the things are same, then basically the value at this point you can sum or you can subtract. So, in this case the net receipt or disbursement, net amount which is transacted will be x minus y. But if the z is also a transaction, but it is at 4. So, in that case its value must be calculated at a point at 2, because it is at different time. So, that is why we discussed about the time value of money. The value which is z here, it is at the time 4 and its value will not be same as that at 2. So, if you want to have the effect of z, now for that you have to find its value, equivalent value at time 2. So, depending upon the rate of interest, now rate of interest and time both will come into picture, and you will use that rate of interest, and with that, and time is also, you can see that there are 2 interest periods, 3 to 4 and 3 to 2. So, this amount is to be its value. So, if you see in a time, since it is moving in forward direction, the value basically its value as the time progresses, depending upon it is lender or it is the borrower. So, its value has to be taken at 2, or else you can have its net value also being mapped at 4. So, that way this its value or equivalent value, that is known as the equivalent value of z at this point. And then so suppose the equivalent value of z at 2 is z prime suppose, then in that case you can have further you can have the net transaction at 2. So, at 2 you can say that your net transaction is x minus y and then plus z prime. So, this basically gives you concept about the time value of money, because how this its value is changing with time. So, that basically gives you about the time value of money. Now, if you go to this slide, so here it is told about the cash flow over time. What is cash flow? Basically, the flow of the transaction which we do, since we are doing in monetary terms, so we call it as the cash flow. Now, as we discussed that you will have the receipts and you will have the disbursements. Receipt means inflow. So, when we talk about the flow of the money or the transaction along a certain a timeline, then wherever you have so now there may be cash flow, and if you look at any particular time zone, so now suppose there is you have taken some amount from the loan. So, this is suppose you have taken some amount from the loan, some amount as a loan from the bank. So, you are giving this as the negative, because since it is disbursement I mean for the bank. Now, for the bank, so if for bank bank has given you, so bank so this will be negative, and then at all the interest periods you will be paying, like that it will go, and it may go up to suppose n periods. So, if you are giving some amount here, you may be giving some amount here, you may give the amount like that. So, basically these are, and suppose at some point again you are taking some amount from the bank, suppose in the same way. So, these are known as the receipts and these are the disbursements. Now, this is for the bank, because you are paying back to the bank, so that is receipt for it, and this is the, since the bank has given you, so it is going in the negative direction, and when you are paying the money to the bank, it will be receipt for the bank. Now, for the borrower it will be different. For borrower the same thing will be, P will be up, because he is receiving the money now from the bank and he will be paying that amount as the time progresses. So since he is losing that money, he is paying that money, so that will be his disbursement. Now, depending upon the rate of interest, so ultimately for the time horizon it has to be seen that the net receipt should be equal to net disbursement, and the rate at which it will be satisfied, that will be the interest rate. So, that is how the interest rate is defined. So, it depends upon the point of view taken of the two parties involved. So, as we discussed that we may have either the lender's viewpoint or the borrower's viewpoint. For lender, so this this what we have drawn. Now, for any transaction, if you see, so what you will see in the case of financial when we talk about the transactions, you may have different type of sometimes you have receipt, disbursement or so. Now, with time when you have such transactions going on, so this is known as a cash flow diagram. So, the cash flow diagram basically will talk about the the different points. So, this is 0. So, this will be 1, 2, this is 3, 4, 5, this is 5, 6 and 7 years. So, this is time, not 2 here, but this is 2, and you will have different monetary units here. So, this diagram which you get, this diagram is known as the cash flow diagram, and the net cash flow at any time t is arithmetic sum of receipts and disbursements that occurs at the same point in time. So, that is what we told, that if you have to find the net cash flow at any point. Now, suppose there may be some case where there is also some disbursement also at this point. So, there will be net cash flow at this point of time. You have to find the arithmetic sum of the transaction which has taken place at this point. So, that is known as the net cash flow. Then if the Ft is less than 0, it is the net cash disbursement, and if Ft is more than 0, it will be net cash receipt. So, this is about a particular time. Now, in this case you can see that if this is a smaller amount as compared to the receipt, then you have net cash receipt of at that particular time. Otherwise, net cash disbursement, if it is more and there is small receipt here, then in that case it is net cash receipt. So, this way you will have a diagrammatic representation of the cash flow over time, and that is known as the cash flow diagram. So, we will deal with these things we have to discuss when we talk about the cash flow diagrams, and you have many kinds of cash flow diagrams, like you may have a single cash flow, or you may have equal uniform cash flow, then you may have the gradient series, like what we do many a times, that you take a loan and you are paying the amount in increasing order. So, you expect that every year you will have increments, so you will be paying larger amount of loan repayment will be done by you. So, that is a gradient series by certain amount, linear gradient. Then if you are increasing in terms of percentage, then it is geometric gradient series, like that. And there may be irregular series also like this. So, you will have irregular series of payments which is done in that cases. So, this is the cash flow, and you can do the analysis based on finding the equivalent values at one particular time, and then you can have the net cash flow or cash net cash flow. You can find it, and ultimately it has to be 0 for a particular interest rate. So, that is how the interest rate is defined, and that gives you the IRR or so, or net MRR or so. There are many terminologies that we will come across as we move in analyzing such problems. Thank you very much.